Whenever the type of investor changes in a market, we tend to see a turnaround point in the price as well. Let's say we have a crypto crash. Everybody has to sell, then a few people are able to pick up the pieces. And that's usually when things get better again. The same is true the other way around. So let's say we are in a bull market and new people come into the space. The long-term holders, they might be selling into the rally. New investors come in, and the new investors might have a shorter time horizon. They just buy because the price is currently going up. When it then stops going up further because all the new investors that might be interested in the asset have already bought, that's then when things turn around, because a little bit of volatility will already shake the confidence of those shorter term investors. The nice thing about crypto is that we can have a look at how is currently the investor base changing. There is an on-chain metric called the realized cap, and it checks how much capital is currently flowing from one investor to another one, how much unrealized profit or unrealized loss currently gets realized. Whenever the realized cap peaks, we also tend to have at least a medium-term peak in the price. This is the Bitcoin price. It was at 73K, then fell all the way down to 53K. That was after the peak in the realized cap. Then we had another peak that happened when the Bitcoin price was close to 100K. So again, long-term holders taking profit. Subsequently, the price fell to 76K. So it's always interesting to look at this measure. How much is currently the investor base changing? The last peak that's worth mentioning happened when Bitcoin was at 112K. Now this looks at the realized cap across all holders. But what about the long-term holders only? And are they currently realizing profit or are they realizing losses? That's what we see over here. We saw a lot of profit taking by the long-term holders when Bitcoin was at 70K roughly. Then the long-term holders bought back in again when Bitcoin was closer to 60K. They sold again when Bitcoin was close to 100K. And recently, the behavior is quite different. As in, there were purchases not at necessarily low prices. So when Bitcoin was at around 108K, and now they are selling, and that's not necessarily into a rally, they're simply selling at elevated prices. In the past, they sold only when the market has heated up already and when we have seen new all-time highs. So there seems to be a fundamental behavior change by the long-term holders. Now there are some entities that tend to just buy long-term. They simply just allocate, and that's the Bitcoin ETFs and the Bitcoin treasury companies. There have been two noteworthy dates. The first noteworthy change was at the beginning of 2024. This is when the ETFs got introduced and when we didn't just have trust companies like Grayscale, but we actually had directly redeemable ETFs that were 100% backed by spot holdings. So that started at the beginning of 2024. At the end of October of the same year, we saw the treasury companies accelerating their purchases again. So this is two waves, first driven by the ETFs, then driven by the treasury companies. Let's have a look at Bitcoin at those 2 points in time. This year being the ETF launch, this year being the acceleration of the purchases through the treasury companies. What we see over here is actually not the regular Bitcoin chart. Instead, we see Bitcoin relative to the Nasdaq 100. So how much is Bitcoin outperforming other risk-on assets? Is it doing better than technology stocks? Because there's an argument to be made that Bitcoin is more volatile than technology stocks. It can underperform quite significantly. This year is a crash of more than 70% in the span of 2 years. But here's the net impact. When the ETFs arrived, Bitcoin outperformed tech stocks by 29% roughly. Once the treasury companies bought more, we saw again an outperformance of roughly 30%. The purchasing has slowed down a little bit in the last month, and we can directly see that in the price performance as well. Bitcoin needs a continuous flow of acquisition in order to outperform tech stocks. Because the bar is quite high, the competition is high for Bitcoin. Stocks get continuously bought through retirement accounts, through 401ks, etc. Bitcoin doesn't have those inflows as regularly yet, at least to the same degree. And so we better see those two entities continue to acquire. Now, what I find fascinating about this chart is that the purchases through the ETFs tend to be more consistent than the purchases through the treasury companies, because the treasury companies are levering their balance sheet, they are levering their Bitcoin holdings as well. And when Bitcoin hits new all-time highs, then the collateral is worth more and they can buy against that collateral. When Bitcoin goes down in price, then the collateral goes down as well. The company inherently becomes more levered, and so it's much harder to buy Bitcoin at lower prices. So as per tendency, we see the treasury companies buying high, not necessarily selling low, right? But definitely buying high. So this is the competitive disadvantage that Michael Saylor and co. finds himself in. He does have plenty of advantages as well, right? He can issue debt that can't get recalled. He issues debt with very low financing costs. He's also got continuous income through selling of the options, etc. But there is a disadvantage, and that is it's very hard to buy Bitcoin after it has crashed. And so I don't expect too much acquisition by the treasury companies if Bitcoin doesn't hit new all-time highs. I do hope though that at least the Bitcoin ETFs will continue to buy. There's another interesting metric to see what the long-term holders are doing, and that is the value days destroyed. That's a nice thing about the blockchain, right? We can see what is every Bitcoin doing at every point in time. And we can see what are the Bitcoin doing that tend to be just dormant, that tend to not move, that are held by the whales, that are held by the diamond hands. If a Bitcoin, for example, did not move for 100 days, and then after 100 days it does get moved, then we have 100 value days that are getting destroyed. If we've got 10 Bitcoin that didn't move for 1,000 days, then we are destroying 10,000 value days. So the longer Bitcoin was dormant and the more Bitcoin is held, the more potential value days we can destroy. When this indicator is going up, that means that dormant Bitcoin suddenly gets reactivated. That means the diamond hands turn into paper hands. The holders with strongest conviction lose suddenly some of that conviction. This indicator was very useful to spot potential medium-term price tops. We had quite a bit of selling when Bitcoin hit 30 to 40k. We had quite a bit of selling when Bitcoin hit 60 to 70k. And while this doesn't necessarily find us the perfect top every single time, it does give us an idea when it might make sense to take at least partial profit. Currently, the long-term holders are not selling at any elevated rates. It appears as if the recent price appreciation from say 60k to 120k has been the most robust we have ever seen in a bull market. Usually, during the course of a bull market, we see the sentiment heating up. We see more and more unrealized profit. We see more and more tourists entering the space. And as there are more tourists, there's also more fragility. The momentum can turn around again. But this time is different. This is the realized HODL ratio. It counts how much trading activity happens between the short-term and the long-term holders. When this is very high, then the short-term holders dominate. When this is very low, the long-term holders dominate. And we should buy whenever the short-term tourists are out. When there's no attention on crypto, we should sell when everybody talks about crypto. Now, what's interesting about the recent development over here is that the price is going up, right, from the 60k to our current prices, while the realized HODL ratio did not go up. It rather tended to decline. That's different to prior bull runs. In prior bull runs, we saw more and more short-term capital entering the space. This time, we do not see that. The market is rather cooling off while the price is increasing. The price, in other words, is increasing at a rate slow enough not to bring in too much hype, to stabilize the ecosystem. What's also fascinating about this chart is how the tops align quite a bit. Have a look at this. We might argue that we aren't necessarily super hot, relatively speaking. We are also not very cheap, of course. But again, the market tended to rather cool off while the price appreciated. It's of course not as straightforward to value cryptocurrencies compared to, say, property or compared to stocks, because property and stocks have regular cash flow, and we can just look at that cash flow and put this into relation to, say, the risk-free rate, or in relation to our purchase price in general. The more return on equity we get within a year, for example, the better potentially an investment is, if of course the cash flows are somewhat reliable. Now, Bitcoin doesn't have cash flows, so there's a different way to value it. I think the best way to value cryptocurrencies is to look at the reference price. Are currently most investors in losses or in profit? If they are currently in a lot of unrealized losses, it might make sense to buy up during those depressed times. When a lot of people are currently in unrealized profit, that unrealized profit might get taken, might get realized, and that will then depress the price. So the current market price always hovers around the realized cost basis. Is currently the average market investor in profit or in losses? And the average cost basis can be seen here at this orange line. Whenever the current price is below the cost basis of the average market investor, it is a phenomenal time to buy. That was after the miner capitulation in 2018. That was during the COVID crash. It was at the height of the crisis after FTX collapsed. And currently we are very far away, unfortunately, from that realized price. It's currently at 55.6K. But this video is more about finding out potential tops, right? At what point are we turning around? We can have a look at this unrealized profit, right? The delta of the current price relative to the average cost basis. And we can put this into relation with the volatility of the market. So is the market rather calm right now, or is it rather hectic right now? If it's more hectic, we can also allow for a bit more unrealized profit. If it's more calm, then it might make sense to take advantage of those elevated prices. Now, this is the indicator. It's the market value to realized value z-score. It looks at the market value, so that's the black line. It looks at the realized value, so this time that's the line in blue. And then z-score means how much are we currently in profit relative to the volatility. And so that's the oscillator. We can see that even though we adjust for volatility, that the peaks relative to the realized price tend to rather decline. Now, there's different ways to potentially look at those declining peaks. We can either look at the optimistic case, that's this line over here, so there's still potential for another rally, or we can be a bit more pessimistic. And then we see this line over here. But then that line doesn't necessarily mean that Bitcoin's price has to come down. It simply means that the current rate of appreciation is probably representative of what's going to happen in the next month. Because again, while this went slightly down, the Bitcoin price during the same time period doubled. That's over the course of roughly 2 years. Let's get into a bit more complex data right now. If you so far enjoy this video, then feel free to give this video a like. Feel free to also subscribe. I publish videos regularly. Let's look into the HODL bands for crypto. So how much of Bitcoin supply is currently held by long-term holders versus medium-term holders versus short-term holders? And let's split this up in a very granular way. Here's the result we are getting. So we look at all of the supply, 100%, and the Bitcoin that hasn't moved for 10 years, that's over here in purple. The Bitcoin that hasn't moved for the last 7 to 10 years, that's here in blue. Right, so we can see that more than 20% of Bitcoin supply hasn't moved for the last 7 years. Now we can go further down the H bands, and what we get is fascinating. This is now the Bitcoin that has moved within the last 12 months. It's currently roughly 40% of the supply, so 60% of Bitcoin supply did not move in the last 12 months. But we can see again how our thesis is justified, as in when the bull market heats up, we tend to see more and more short-term investors getting into Bitcoin. The long-term holders are selling into the rally, the short-term holders jump onto the media attention. If you're using this metric, the market indeed is heating up a little bit since Bitcoin hit 40K. So the 3x in Bitcoin did bring us more short-term investors, but not much. If we go one more H-band down, we have a better timing for the absolute peak of the bull markets. So that's over here. And we are not yet at another peak. The market could be regarded as less heated compared to when Bitcoin was at around 90K. Still, it's all about risk versus reward, right? We have to also calculate what happens in the worst case. We can't put all our eggs into one basket. We can't put 90% of our net worth into Bitcoin or into crypto as a whole, right? There's a lot of correlation within the market. We still need to be able to buy the bottom even if we crash. And if we do crash, the question is, how much could we crash? Now, we've already looked at the realized price and we've determined that we are at 55K here. Now, at the bottom of a bear market, we tend to fall below that realized price, right? The realized price here was at 4,900, yet the Bitcoin price fell all the way down to 3,200. The same is true over here. The realized price was at 21K. We fall all the way down to 16K. So 55K might not be the bottom. We might fall maybe even to 40K. There's an even more bleak look at the situation, because in prior bear markets we also went below the long-term holder realized price. That's true for the miner capitulation. It's almost true for the COVID crash. It's also true for the FTX collapse. And unfortunately, here the average cost basis is at 37K. So that would imply a bottom of a potential bear market of maybe 35, maybe 32K, something that's unimaginable at current prices. Now, while this is the worst case, I do not expect this to realize at all, because again, the market tends to be less heated now than it was just a year ago. Here's a different way to look at this. The net unrealized profit and loss in percent. And again, this tends to rather go down recently. Since Bitcoin hit 60K, the net unrealized profit went down, the market has cooled off. And it's always risky when this is peaking, right? When people have a lot of green in their portfolio, they might take advantage of those great profit numbers and they might take the profit to just consume or to use it for other investments, maybe buy a house, etc. But when the net unrealized profit isn't historically high, maybe it doesn't make sense to sell as aggressively. Now again, we can see how the peaks tend to align and how this is actually going down. The same is true for the bottoms, by the way. We can draw lines. Here we are. We are in healthy, bullish territory. Of course, there's the risk of a potential crash, but the market hasn't heated up more while Bitcoin still doubled in price. The best time to buy is, of course, when nobody wants to buy, when everybody is in losses. Unfortunately, we are not there right now. But I will stick around and I will talk about the exact same indicators in the future on this channel as well. By the way, you can also bookmark this yourself, right? Simply just search for checkonchain.com and search for the net unrealized profit and loss metric. And so maybe the long-term holders aren't that wrong to take some profit. We are relatively high in the price. Yes, the market is not heated, but we need continued inflows through Wall Street. And those inflows will not come from the treasury companies. It's very unlikely because they need higher prices to buy more. The additional demand has to come from the ETFs mainly. What I find fascinating is that the development within the altcoin market seems to move contrary to what's happening in Bitcoin. So when Bitcoin tends to do better, then the altcoins are rather weak. When the altcoins tend to do better, then Bitcoin tends to be weak. What we're seeing over here, that's the others dominance. So how much of all of crypto is in the altcoins that are not in the top 10 in terms of market cap? So it's a percent range that tends to peak out at around 20%. It's currently at 7%. Now have a look at the following. Let's have a look at the peaks and the bottoms. Let's also see where there's a potential support. That's maybe here. And let's now compare this with the Bitcoin dominance. So how much of all of crypto is currently in Bitcoin? Whenever the others dominance is peaking, the Bitcoin dominance tends to be low. Whenever the others dominance is bottoming, the Bitcoin dominance tends to be high. Here's another such peak where the Bitcoin dominance is high and the others dominance is low. So there seems to be a direct inverse correlation. And since the beginning of 2022, the altcoins tend to underperform and Bitcoin tends to outperform. And Bitcoin tends to trade in a range. It tends to peak at a dominance of 73%. So once Bitcoin is 73% of all of crypto, the altcoins historically were very cheap. The problem for altcoins right now is that the others dominance still continues to go down and Bitcoin dominance still tends to go up. And while the others dominance didn't necessarily always bottom at the exact same level. It tended to be somewhere around 5 to 6%. And currently we are at 7% dominance. And again, Bitcoin dominance has way more room to go until the altcoins become historically cheap again. So really, it does make sense to be selective when purchasing alts. It's maybe not the best time to have a diversified altcoin portfolio because most of them are likely going to be worse medium-term performers. What we see over here is the others market cap. So how much capital is currently in the altcoins that are not in the top 10? We're not looking at the others dominance, but at the others market cap. And the altcoins do have a hard time getting above 500 billion market cap in aggregate. Here's a similar metric. This is total 3 ES. So that's all the altcoins that are not Bitcoin and Ethereum, and we also exclude the stablecoin. This metric has a hard time going above 1 trillion. There is a fundamental problem though with all of those metrics. So with the others dominance, with the others market cap, with the total 3 ES market cap, the problem is that market caps are not a good indication of where prices are going. And prices in the end determine our performance as an investor. Let me show you what I mean. Here as a representative example, we've got WorldCoin. WorldCoin tends to peak at higher highs in its market cap over the very long term. Yes, we've got our volatility. Currently, we tend to dip a little bit, but in general, over time, the market cap is going up. Now compare this with the long-term price chart. That's very different, right? It's not going up from peak to peak. The peaks are lower over time. And the reason for that is token inflation. It's the number of WLD or WorldCoin tokens that get issued over time. The supply grew by 8x over the span of a bit over 2 years. That's of course very extreme, but in general, we tend to see most altcoins expanding their supply quicker than Bitcoin or Ethereum or Solana over time. The effect is very drastic. So every week we see more than 1 billion worth of unlocks in the altcoin market. And that's just for the altcoins that are tracked here on this website, tokenomics.ai. And so I believe this is where the market inefficiency is, where we can actually exploit that inefficiency and make money. Because it seems to be obvious that something like WorldCoin should go down in price over time. It might not go down in market cap, but it will go down in price if the supply expands this way. Yet, the vast majority of traders does not agree. Have a look at this. This is the perpetual futures funding rate. So with perpetual futures, we are betting on a price. We are not buying the asset, we are betting on the price to go in either direction, to the long side, so it goes up, or to the short side, it goes down. And because the funding rate is positive most of the time, most traders on the perpetual futures market are betting on WorldCoin going up long term. They're also betting on it going up right now. Again, despite the supply expansion, despite what history has already told us. Isn't that interesting? Most perp traders got wrecked because of the token inflation. Or in other words, the token inflation is not properly priced into the funding rate. And so really, the game should not necessarily be to try to find the next small altcoin that does another 10 or 100x. Here's the performance of the smaller altcoins in the last year. Most of them went down. Yes, the larger altcoins did better. So here's the performance of the top 100, but still, even they, in aggregate, went up only by 43% in the last year. While at the same time, Bitcoin went up by 71%. Ethereum went up by 69%. So even the biggest of the altcoins aren't doing great. The smaller altcoins do even worse. Have a look at this. This is Hyperliquid. This is the funding rate of WorldCoin right now. It's 11%. The longs have to pay the shorts 11% per annum to bet on rising prices. In other words, when we bet on falling prices of something like WorldCoin, we are even getting paid 11% per annum. And then we are making money on top of that because of the long-term underperformance. This is the WorldCoin price relative to Bitcoin over the long term. It went down by more than 90%. But now imagine we are flipping this around. We are betting on falling prices of highly inflating altcoins. At the same time, we bet on rising prices of Bitcoin, Ethereum, or Solana. So instead of having this relative performance, we are getting this relative performance. Isn't that much more attractive than even just buying Bitcoin itself? This is a performance of 900% Bitcoin during the same time period made a performance of 289%. So there's clearly alpha in a strategy like this. There's also volatility, like we see over here, but this is a quote-unquote buying opportunity, right? We double down on being even more long Bitcoin and even more short WorldCoin. If you, of course, believe that long-term the tokenomics will prevail, which they have over years. And again, this is just an example. Many altcoins work like this. The overall altcoin market sees massive unlocks every single week. And the reason why those unlocks exist is because the venture capitalists, they want to pull out their capital. The team wants to pull out capital. The insiders, the KOLs, etc., they want to pull out the capital. They are all dumping on the retail investor, and they are dumping at a very quick rate. That is very harmful for the altcoin market. That's why we see this performance across the board. I'm following this kind of strategy already for 4 years. In the early days, it was with borrowing and lending platforms like Aave. Nowadays, it's with perpetual futures. And this is my long-term performance here. So this is a monthly chart. It shows the last 4 years. Had I just dollar cost average into Bitcoin, I would have gotten this return here at this light gray line. But because I also bet on falling altcoins over time, I got long-term outperformance. And this is really what crypto should all be about. It's about the constant alpha. It's not about finding the 1 or 2 lucky moonshots. We want to simply compound our capital reliably over time. I have made many videos on the topic, but you don't have to watch all of those videos. You can simply stick with 3 of them. The first one is over here, using perpetual futures to bet on relative valuations. Then this one over here, risk management with relative valuation bets. Very important. People that didn't have this in place, they got wrecked in the recent crypto shakeout, which was, by the way, one of our most profitable days. Everybody has lost their money, but we had our risk management properly in place. And one part of that risk management is, of course, also setting effective stop losses. So that's video number 3. In total, all 3 of those videos combined is roughly 1 hour of content. Once you've watched that content and you've joined the community, I will share my favorite trade with you. If you do not make money with that trade after opening it and after holding it for 1 month, then I'll refund the premium membership fees to you. So really, you are not risking those $125 per month. If you do not like premium, if you do not make money with that trade that I will send you after joining, then I will just send that money back, no questions asked. A link to premium will pop up directly here on the screen. Just click on that. It will lead you to the website. If it's the very first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube, or see you in premium.